So thanks, Eloise, and it's great to be here to give you our view of the housing market outlook for 2024. I do want to talk about some of the implications for the demand for secured credit and mortgages as we go through this. And I really want to focus on the sales market to start with, and then look at what's happening in the lettings market. Buy-to-let investment, a really important part of the overall mortgage picture. I think the big story really has been the increase in mortgage rates over the last year. And that has suppressed buyer demand for property after 3 really strong years over the pandemic, where locking everyone in their homes for 3 months meant everyone sort of reassessed what they wanted from a property. And this chart here shows applicant demand, how many people are getting in touch with an estate agent about buying a property that's listed for sale on Zoopla, and it's indexed to 100 over the last 5 years. Very seasonal, but you can see there those 3 big peaks in 2020, 21, 22. And then the market really slowed after the mini budget. We saw a rebound earlier this year as some pent-up demand came back into the market. Mortgage rates fell to about 4.2% for a 5-year fix at 75 LTV. But ever since mortgage rates started to increase over the summer, demand has sort of fallen back in line with where it was in 2017, 18, 19. So we've seen more of a return to normal levels of buyer demand. I think where housing is more affordable, demand is holding up better, and the real squeeze on demand is in those high value housing markets. Now, house prices haven't fallen as much as many people expected. We definitely thought there'd be a soft landing for the housing market. We didn't see a big overvaluation. I think a lot of people didn't appreciate the impact of mortgage affordability stress testing and how that's made sure that people could afford to pay higher rates when they came to refinance. And so this chart just summarizes a snapshot of our house price index by postcode area level. So there's 122 dots here. It just gives you a snapshot of what's happening across the whole housing market in one view. On the vertical axis is annual house price inflation, which in our index is minus 1.1 at the UK level. But along the bottom axis, we've got the average price of homes in each of these areas. And you can see there, about 80% of markets are registering year-on-year falls. Those falls are pretty small, especially in the context of how much prices went up since the start of the pandemic. And there are still parts of the market where housing is relatively affordable and house price growth has slowed, but it hasn't moved into negative territory yet. The big price falls are being seen, or the bigger price falls are being seen in commuter towns across the southeast of England. This is where prices have went up the most over the pandemic. And again, those higher house prices are sort of putting more downward pressure on buying power and affordability. Interestingly, in London, where house prices are much higher, it's not like prices are accelerating downwards. House prices in London have underperformed over the last 6 or 7 years. So there's some relative value for money there. And that's why we're not seeing a big downward pressure on prices. And we probably think this pattern is going to continue over most of 2024. Perhaps more important than prices, and look, prices are really important for consumers. If you're a homeowner, the value you can get for your home today unlocks your next move. If you're looking to buy your first property, then prices matter in terms of affordability. What matters more to industry, to brokers, to lenders, to estate agents is liquidity. How many people are moving? Now, this is just for the home purchase side of things, but this chart here shows the 50 years of housing transactions in the UK. Roughly 75% of all these transactions are using mortgage finance to support them. And the big story is this year, we're going to see a 23% drop in housing sales compared to last year. And the last 2 years, 21, 22, have had above average levels of housing transactions. The long run average is 1.2. We're going to see 1 million this year, again, which is better than some people predicted this time last year. The big story within this, though, is that it's people buying with a mortgage where the real squeeze has been, people delaying purchase decisions, waiting till the outlook becomes clearer on where mortgage rates are going. And interestingly, the number of cash buyers in the market is actually going to be flat on last year. So the real squeeze, as you'd expect, has been seen in those needing finance to move. And we think next year it's going to be another million-year number of transactions. There could be some upside to that, but a lot depends on how money markets and financial markets see the base rate developing, and therefore that impacts them to the cost of finance that underpins mortgages. And I think when it comes to mortgages, we've sort of got a 2-tier lending market. Obviously, the total gross value of mortgage lending is a mixture of remortgage, home purchase, and if you then add in product transfer on the top, it's really important. But again, LTV really matters because LTV really drives pricing. The best rates are obviously available at the lower LTVs. And what this chart shows is some data from HomeTrack. It shows basically the LTV profile of all outstanding mortgages. And the key message here is 9 in 10 mortgages have got outstanding mortgages have got an LTV of less than 75%. So this is where lenders are competing the most, particularly on product transfer at the moment. And it's also then the competition for product transfer has reduced volumes in the remortgage market. And again, partly that is because half of people remortgaging in recent years have tended to borrow more money. So there's probably less appetite for people to borrow more money. But again, banks are looking to do automated lending, much better use of data and processes for this sub 75 type lending. But obviously, as soon as you get into people who are doing new deals, new remortgages, new purchases, so this is all sale, the LTV profile of all mortgage sales. You can see we've got higher, over 75 LTV lending coming through. And if we look at first-time buyers, I mean, it really is, largely over 75% loan to value, and at higher loan to value, that's bigger mortgages, bigger repayments, and that's where demand is being squeezed. So I really see the lending market breaking down into this sub 75 LTV, process, efficiency, automation, automated valuation models side of things. And then I think, the purchase and the sort of higher risk remo market is over 75 LTV, where frankly higher mortgage rates create more pressure. In terms of home purchase demand next year, we did a big survey of consumers. 16% of the population want to buy or move home in the next 2 years. The lime green coloured lines here show who's going to be buying in the next 2 years. So 40% of people who want to buy in the next 2 years are first-time buyers. So first-time buyers remain a really, really important audience. If we focus on the buyers who are also sellers, which is the grey bars, it's all about upsizers. Look at that, 45% of people want to move to a bigger home. And again, they're going to be thinking twice, what are mortgage rates? And again, importantly, do I need to move further afield? And again, that's the second bar from the right-hand side. Quite a lot of people are looking to move out of where they live today to a different area, often to get better value for money in the face of higher borrowing costs. I think a lot of these upsizers are also looking for certain features in property, and almost they know they've got to pay more money, they know their mortgage payments, they're going to be more demanding of the type of property they want to buy. So there's still demand to move and sales are holding up, but buyers are just becoming more choosy. On the letting side of things, the ongoing supply-demand mismatch we've seen over the last few years is still really locked in. Although I think 2024 is going to be a year when rental growth is certainly going to slow. The chart on the left-hand side here shows how many homes on average there are for rent per estate agent on Zoopla. It's down by about a third on where it normally is. So just 10 homes for rent per estate agent. It's even lower in some hotspot areas. It's just not been increasing because we've seen much weaker demand from buy-to-let landlords buying property. But on the other flip side, on the right-hand chart, we've seen an incredible increase in demand for rented housing. And so this is actually showing the number of inquiries per home for rent on Zoopla. And again, you can see how it's just massively increased over the pandemic years, big spike last year. And this is for three things, really. Number one, record immigration into the UK creates a lot of demand for rented housing, particularly from students, record overseas student numbers, not enough purpose-built student accommodation. We've also seen then the strength of the labour market, which drives demand for rented housing. And then higher mortgage rates make it more unaffordable for first-time buyers and keeps more people in the rental market. And this is why we've seen very strong demand for rented housing, which has kept rents rising quickly. And rents for new lets, when a property becomes vacant, it's what our index tracks, rents are rising faster than earnings. So earnings growth, the latest figures are 7.7%. And this chart shows that in London, just how quickly rents have been rising up to nearly 17-18% year on year a year ago. That slowed to 10, but all of these lines are over 10%. There's just the demand for rented housing comes through. Now, rents can rise faster than earnings for a period of time, but if they rise faster than earnings for too long, then renters just run out of affordability, and that's going to really stall the rate of growth. So we do think the rate of rental growth is going to slow next year. I think in London, it could get back down to close to 0%, just on affordability pressures. It's probably going to be in the 4 to 6% zone for the rest of the UK. Interestingly, in Scotland, where they brought in rent controls, rents are actually accelerating upwards. In Edinburgh, rents are up 17% in the last year. And rent controls are having a sort of distorting impact on the market. And it's a great example of how rent controls aren't a great idea if you want to sort of manage rental inflation. In terms of what's all this doing for landlords, because on the face of it, this is fantastic news for landlords. The strength of the underlying cash flow is really important, but it's higher mortgage rates combined with recent tax changes since 2016 that are hitting landlords, and they're really hitting landlords with higher loan to value portfolios. This chart shows a summary or our estimates of all the private landlords out there. We think 40% have got no mortgage at all. About a third have got a lower LTV mortgage. And then around about 30% of landlords have got a higher LTV mortgage. And it's these higher loan to value mortgaged landlords where the real squeeze from mortgage rates is coming. And so if we have a look at, let's assume we're the typical average landlord, we've got an average price rented home, £215,000, generating just under £1,000 a month in rent. The lime coloured bars are the mortgage interest payments on interest only that I would have been paying before I refinance. If I refinance onto 5.5% mortgage rate, that's then the brown coloured bars. Now they're all still underneath the gross rent I'm getting, but a lender will want to see that that rent is at least 125% or 145% of my maximum interest payments, depending on whether I'm a lower rate taxpayer in the black, higher rate taxpayer in the green. And so what you can start to see is higher mortgage rate means that sort of using leverage to buy a property is getting more challenging. Even at 60, 65 LTV, when you come to refinance, you're going to not have any or much profit rent left at all. And this is what's really hitting landlords when they come to refinance. So in terms of the outlook for the overall housing market, we think house prices are going to fall by 2% in 2024. They're going to be flat in 2025. We've talked about 1 million sales, but I do think there's upside to that in 2025. And the real purchase markets here are first-time buyers and upsizers, but upsizers are looking further afield for better value for money and also focusing on features. In the lettings market, the supply demand is not really going to go away. We are going to see headline rental growth slow. And again, I think the new investment in the market is going to be coming from larger landlords. 1 in 5 landlords in this country owns half of all private rented housing. So it's the smaller landlords who don't see it as a business who are selling up. It's the professional landlords who are far more likely to be investing and wanting advice on how to grow their portfolios. And I think given this, it is a tough outlook. It's not fantastic. It's sort of almost a normal market with some challenges. People still want to move and rent property. There's still business to be done. But if the market's not driving natural business growth, then I think all businesses involved in housing and mortgages need to think about how they invest in data, process automation, technology to really drive efficiency and to make sure that your people are focusing on the things that add the most value, and there's more automation and efficiency to help support that business growth and profitability over 2024 and into 2025. Thank you very much.